You s-
Hello, everyone. Welcome to today's live market update. My name is John Pasalis. For those of you who are new to our segment, I have a brokerage in Toronto, as you can see on our screen, or for those of you who are listening on the podcast, Realosophy Realty. We help buyers and sellers throughout the Toronto area. And I like hosting this live update to unpack some of the latest trends we're seeing in Toronto's housing market. What are the statistics telling us in terms of what is happening? What are we observing on the ground? And we're going to talk about some of the latest mortgage and financial trends and macroeconomic trends as well. As always, we're going to have a couple of people on our team. I didn't update our slide. It's not Davin and Anastasia, it's Davin and Gus today, and David Larock, mortgage broker, as always. Now, before I kick off and kind of go over some of the latest statistics, a quick note, a couple of weeks ago, I launched a new report and video on our YouTube channel and on moosefindley.com. You can download a report called The Great Sell-Off that talks about how our homes became someone else's business, this real transition from homes that used to be affordable shelter to a financial asset. And this is really a market where homes used to be anchored by incomes to a world today where they're driven by capital. And it's really one of the key reasons why housing has been so unaffordable and has become completely disconnected from household income. So if you haven't already, please take a look at that. Let me know what you think, and I appreciate your feedback. And of course, as I mentioned in the past couple of months, I've launched a 30-minute webinar helping people who are buying and selling in this market. It is a particularly challenging time if you have to time to new transactions. And I discuss in this webinar, in this info session, and we're gonna have the link in the show notes, how we think about what to do first. Do you buy, sell? Do you sell first? And what are the strategies to mitigate risk? And the reality is, the answer to some of these questions sometimes changes from week to week. There's no one strategy. It depends on the house you're buying. It depends on the house that you need to sell. And it depends on how market conditions are evolving in your neighborhood. So please take a look at that. At least you'll get more information. As always, if you'd like to meet with me and my team to discuss your own buying decisions and selling decisions, you can click the link in the show notes or shoot me an email at askjohn@movesmartly.com. Now, the first thing I wanted to kind of chat about is something that someone had sent me, a YouTube video someone sent me, where a commentator was talking about how house prices in the GTA are plummeting. According to this discussion, low-rise home prices are down over 20%, and condo prices a whopping 30%, apparently. So someone, of course, sent this to me asking me, is this what's going on? A client. And I had to look at and listen to what was going on and look at the data. And the short answer was absolutely not. Home prices have not crashed 23%. Condo prices have not crashed 30%. What looks like was happening in this particular video, the person who was speaking was looking at the change in the number of home sales and condo sales year over year, which matched kind of the numbers he was talking about. But maybe he misspoke and was talking about prices, and it sounded like he was referring to prices. So a reminder that you always need to be cautious. Obviously, when you're looking at content on platforms like YouTube or whatever, it's important to fact check. I mean, honestly, if I made a mistake like that, I'd probably delete the video because I'd be so embarrassed by talking about prices crashing when it's really sales crashing. But you need to be mindful of this when you're looking at statistics. So on that note, let's take a look at some of the statistics in the GTA. We're going to look at the statistics for houses and condos separately. And as always, we have Urmi Desai from Move Smartly on our show here. Keep an eye on your comments. So if you have questions, please post them in the chat. So when we look at number of sales for detached homes, in the Greater Toronto area for the month of April, we're at about 2,600-ish or so, which is the lowest volume of sales over the past roughly 30 years, aside from the April 2020, which were the lockdowns sort of at the start of COVID. So if we take that period out where we had just started the COVID lockdowns, we're pretty much at the lowest volume in 30 years. So it's an unbelievable statistic. We see it as agents on the ground, how sluggish the market is. Homes aren't selling, they're sitting in the market a little bit longer. And it's largely because there's just not a lot of buyers out there. There's just not a lot of activity. People are anxious to move. As I mentioned earlier, if you need to upsize and need to buy and sell two homes, it is a difficult time to do that. There's so much uncertainty. So a lot of the people who need to time two transactions are on the sidelines unless they really need to move. So, of course, sales at their lowest level. When we look at new listings volumes are rather typical for the month of April, just over 8,000. Nothing out of the ordinary, a very average, I'd say, volume of new listings, but active listings are quite elevated, just under 12,000 active listings. Now that is that is well above the previous 4 or 5 years, but those years we didn't have a ton of listings sitting in the market. We had extraordinary demand, especially leading up to 2021. But we're at the same volumes as we had, or just above that from 2018, 2019, when the market was quite sluggish. So this volume of active listings is, an indication of a relatively slow market. Interestingly enough, similar volumes, back in 2006, 2007, that time period. So relatively high volume of active listings. And we're seeing this in months of inventory, which is basically active listings divided by sales. And we're just over 4.4 months, which is relatively high for the GTA. And we got to keep in mind that this is an average, right? So when we keep that in mind, I'm going to chat about that lower. It means some areas could have 6 or 7 months of inventory. Other areas have 2 months of inventory. So it doesn't mean everything in the GTA is in the same thing. There are differences across regions. One thing I should say actually is that if we look at months of inventory back a year ago, April, May, we were at about 2.5 months. So the market was actually way more competitive last year than it is this year, this time. And I think that's one important thing to keep in mind. It was a different market. When we look at prices actually accelerated in the first quarter of 2024 last year. And we can see this, with average prices hitting close to, almost 1.4 for low-rise homes last year. And now we're in the low 1.3 range. So average prices in the GTA for houses are actually down about 6-7%. It's the first somewhat meaningful decline since up until maybe last month. Everything has been pretty much flat-ish year over year. But we're seeing this dip because we're comparing ourselves to this spike in April and May last year when the market was relatively tight. So that's what's going on largely in the low-rise market. When we look at condos, somewhat similar trends. Sales are well below typical volumes, just under 1,500 condo sales. Last time we were at this level was about 20 years ago in 2003. Again, leaving the COVID lockdowns aside. And I just wanted to make sure, can everyone see my charts in the live update? I think we're all good, right? Yes, we are. Sales very soft. When we look at new listings are pretty much at the highest level they've been for the month of April ever. Just about 5,500 new listings of condominiums. And of course, the bigger number is active listings of condo apartments, just under 10,000. So a ton of active listings of condominiums. It is probably the segment of the market that is the slowest right now, and in particular, smaller units. And last month's update, I kind of did a brief cross section of what's going on between really small units and larger units, and kind of showed how months of inventory is a lot higher if we were looking at small units when compared to larger units, even in the same area right downtown. Inventory levels hit 7 months of inventory for condominiums, and condos as well, just like houses, are down about 6% year over year average prices. Now, one thing I wanted to chat about was something I touched on earlier, this difference between what is going on in different regions of the market, different segments, different house types. In this case, we're going to look at low-rise homes. So this is detached semis townhomes, and what is happening between the city of Toronto and the suburban markets, because the trends are a little bit different. Specifically, right now, I just want to look at how average prices have changed for each of these. And I'm going to look at, just to give ourselves some context, how the average price has changed year over year for the month of January, February, March, April. So that's 4 months. And we're going to look at these differences across the 5 regions. Durham region, which is the east of Toronto, Halton and Peel, which is west, and York, which is north of Toronto. So how have average prices changed for the past 4 months in each of these regions? And if we look at that in sort of a chart, what we see is that for pretty much all of these suburban regions, Durham, Halton, Peel, and York, the average change in price has largely been increasing. It was relatively modest to start the year, and now average prices are down anywhere from 5 to 9% in some regions year over year for the month of April. So we're seeing the year-over-year decline somewhat accelerate. Whereas in the city of Toronto, the year-over-year declines are a little bit modest. We are down 2% in February, up 2% actually in March, and now down 2%-ish in April. So more modest declines. And this tracks with what we're seeing on the ground. When we have clients looking in the city of Toronto and some of the central neighborhoods, the market is surprisingly busy. It's somewhat competitive. Homes sell quickly. Homes are getting multiple offers. Homes are getting bully offers, if you could believe it, in some cases. So, we have clients looking in these regions saying, what the heck is going on? I hear the market's slow. I hear sales are plummeting. But yeah, the market is slow in some regions and much slower in other regions. Downtown urban neighborhoods have been holding up a little bit better. So I think it's important to obviously keep some of these differences in mind when you're buying or when you're selling. That we gotta take the headlines with a grain of salt. Not everything is kind of performing the same way when we look at the statistics across the GTA. So last thing I'll look at before I bring Davin and Gus on is sort of the months of inventory when we look at it weekly. And we can kind of see it's been ticking up gradually for houses. We're getting close to 5 months of inventory, but it keeps accelerating for condominiums. We're over 7 months of inventory. And again, this buildup of inventory is a sign, again, that new listings are outpacing sales. And as inventory builds up, you start to see a little bit more pressure on sellers. Some sellers cut their prices just to move on. So I think this is going to be an important metric to keep an eye on. How does the market evolve? How do prices reflect sort of changes in inventory levels in the months ahead? So with that, I'm going to bring on Gus and Davin. I don't know if you guys are around. Let me stop. All right. Beautiful.
Hello.
All righty. Thank you, guys. So yeah, just wanted to kind of kick off with your, as we always do, your thoughts on some of the shifts and trends we're seeing in the market on the ground. I mean, I'll kick off maybe with my preliminary thoughts that it feels, even in some of the urban neighborhoods, I talk about that downtown's moving a little bit better. I mean, I'm kind of in central Toronto. This is what I look at more often. And it does feel slower now than it did even a month ago. Just fewer showings, fewer offers on properties. So it feels like things are cooling down a little bit. I don't know if it is, again, the headlines about prices going down year over year, if that's impacting sentiment, but I do feel like it is a little bit slower. Homes are still selling in urban areas, but it just feels a little less competitive. That's my take. What are you guys both seeing on the ground? Maybe Gus, we'll start with you.
Sure. Yeah, I mean, the word is apathy. That's what it feels like. There's people watching, there's people talking, there's people asking questions, but there's not a lot of people actually going out to look at homes, and there's not a lot of showings. And yeah, especially since I would say even February and March, there were homes, nice turnkey homes that were getting multiple offers. It seems to have calmed down in the last couple of weeks, especially even in some of the sought after neighborhoods. But I mean, I think we're still going to get sales in those neighborhoods. When a home is renovated, it's still going to get activity, but definitely a little bit slower. May not get. I remember there was one in Leslieville about 3 weeks ago that got 8 or 9 offers. There was a couple others in a couple other neighborhoods, Junction and whatnot, that got 10 offers. And I don't know if they're going to get those today. They
Mhm.
might get a little less. So definitely on that. On the lease front, I've been dealing with a couple leases. Those are fairly sluggish too, but interesting that some of the larger leases are actually in these same nicer neighborhoods, like a detached or a semi-detached house, 3-bedroom house that's leasing, is actually getting a lot more attention, which is interesting.
Yeah,
Which makes
100%.
sense,
Those
right?
are competitive. Yeah, I mean, I think I mentioned on one of the last updates, I listed a house just up the street from our office, like low rise, 3-bedroom semi. We had like 10 showings in the first 2 days and multiple offers on it, like 3 people bidding, and all excellent tenants making extremely high incomes, people who could buy that home, but are just deciding not to buy right now. So it's very interesting that you have all these people effectively just hitting pause and waiting to see
I,
what
I
happens.
have a couple of those clients, and they have a healthy down payment and very good income, but they're choosing not to buy, and we're looking at to lease
Yeah,
within the neighborhood that they may eventually buy.
yeah,
So and they want to the comment is, no, let's just lease for now. We don't mind paying a little extra. We'll enjoy the neighborhood the same way as if we were to buy. But guess what? We don't have a risk now. There's
yeah,
not no down factor. And if the market slips and goes down further, well then we'll jump in and buy in 10 or 12 months. And if it doesn't, we're okay with that, and we'll buy when we're ready.
yeah. That's super interesting. Yeah, I'm
Yeah, our
finding.
clients similar in a situation, I guess, kind of like that. But I don't know if you guys are noticing or have heard people who have down payments that are tied to investments. They're
Oh
having
yeah,
a they're having to go, right. If you are going to be, gaining or losing 5% on the whim of what somebody says south of the border, it's tough to do something, right? Because you're not going to pull that investment out until it's time to, actually make that down payment or the lion's share of it. So it's tough. It's
It's
kind of wild,
it's
especially if
interesting
you're
you say
heavy in
that,
like one
Dad.
particular sector. It's a real thing.
Yeah, it's interesting you say that because I can think of one or two people that are exactly in that position. So sorry to cut you off, but yeah, yeah, definitely see that.
yeah. I
Sorry,
think
guys,
it's
I'm coming live from an actual like listing coming up. We're actually doing photos, so I'm just gonna change locale.
you're on site. You're on site. Yeah.
Oh, hey, I see Dan right there. Here he is. Hi, Dan. All right, sorry, guys.
um, when we have clients, I mean, who are buying and they have their down payment and investments. I mean, I always tell them they need to cash out because if you have a certain down payment and equities, market dips 10-15%, all of a sudden the down payment you thought you had is a lot lower. That's not a great position to be in. So, and it's a tough position. Like you have to basically cash out the second you decide you want to actively get in the market. So, and yeah, when stocks are down quite a bit, it's a tough position to be in.
Yeah, for sure.
Yeah. Anything else you guys are seeing on the leasing side or buying side or listings?
Well, I mean, since I'm here, yeah, you're talking about listing homes in the city, how, they're moving along. If you have something that's good.
Hmm.
If you're in the burbs, like we're in Water down here, which is technically not even GTA, but I mean, I would call it Burlington North for those who aren't familiar. Um, yeah, it's a little more difficult, right? If you're buying here, it's actually kind of nice, right? You can kind of take your time, take in some product, really digest it, probably get it for a price that you like. But when you are listing, you got to do a lot of good work. You got to present it really well. I mean, we've got this place, prepped and staged up a little bit, and obviously Dan's going to do his thing. You have to stand out. You really have to stand out to get showings, to get offers.
And are places just sitting on the market a lot longer? I mean, I would think they are in some of those more distant suburban regions, like just kind of weeks and months, basically.
Things are selling. There are some that are sitting on the market, but these are ones honestly that were purchased as investments in 2022.
Oh, really?
They just kind of recently finished. The old like construction site. There's no like real grass yet, things like that. They're on the market for a good 100, 150K more than they would probably reasonably sell for.
Oh, wow.
Those are sitting. Those people have to, kind of figure out where they are in terms of price. But the ones that are, as usual, priced right and kind of make sense for the average family. I mean, we're talking about like 3, 4 bedroom homes here. They do move. They do move, and they don't move for some outrageously low price. And I see some getting multiple offers, and they usually land within 1 or 2% of the purchase price, up or down. So the pricing is very important to get feet in the ground and let people see some value.
Yeah, I think there's a lot of owners now who are still in this this loss aversion mindset. In some cases they're actually losing money because they bought in 2021 or, kind of at the peak of the market. In some cases they're not really losing money, they're just looking at what they could have sold for and see that as a loss. And a lot of people are just kind of pricing more than what they're worth. And you're right. I mean, that's kind of contributing to the high inventory, that there's just a lot of these properties that aren't realistic. They're just kind of going to sit there. And especially like if you have a condo even if you're priced well in today's market, you're not going to get a lot of showing. So if you're like 5% above, I mean, good luck.
Yeah, talking about pricing, I mean, this has to do with lease, but I had a client who just closed on a brand new condo, brand new building right downtown, and there's probably like 20 something leases up for grabs right now, and we went to lease it as well. And he's a corner unit, which is unique, but still, there was 3 or 4 others kind of sitting there at a higher price point. So, he doesn't want to, especially on a new condo, it could sit there for months, right? Until you figure out what the right price is. So instead of pricing market or slightly higher, my advice to him was price under market, price it a little lower, make it attractive. We're going to get showings, and then you can be selective. And that's kind of what we did. And uh, instead of pricing at 3,100, we priced at 2,950. Got quite a few showings within the weekend, and we leased it right away in 5 days. We had a couple different applications, and he's got a great tenant now. And it's important for the landlord to understand that, because it's a new build, he's able to. I mean, later on next year, if the market picks up and rents are starting to go on the upswing, he could also, bump the rent a little bit. So maybe he's taking $150 or $200 less right now, but hey, he's not sitting on the market for 3, 4 months, right? So definitely, whether you're selling or leasing, yeah, pricing aggressively right now is important to get buyers to look at you, the few buyers that are out there. And then the other comment I'd say is listings. Especially for freeholds, but even for condos, I'm noticing. I don't know. I mean, I know you showed the months of inventory, John, but it doesn't look like they're spiking as fast as they used to be. And I know it's early. I'm not trying to predict, but it just seems like maybe people with the news, and this usually happens in other cycles of the market where when the news is negative and oh my goodness, prices are down and you can't get as much as you wanted to. There are people that are late to the game, so to speak, that are listing, and they're like, oh, I can't get what my neighbor got 6 months ago or a year ago. Well, I'm not listing now. I don't know if that's happening, that dynamic is happening, but I just feel like we may see, I mean, typically in the summer months, we see a few less listings. I know we're not quite there yet, but I'm wondering if listings will start to kind of plateau, which is something to keep an eye on.
Yeah, definitely. We'll see how it plays out. Again, if sellers see the market sluggish, if they don't need to sell, yeah, some people might just wait. I mean, I think obviously with the condo market, I think people are trying to unload them. Unless like your client obviously wants to rent it. Interesting, they said it's a new build and they closed on it. So, there are new builds with all the stories of people struggling. Of course, the majority of people are still closing, even if they were negative equity on them, which is very common where the purchase price is more than what the unit's actually worth. A lot of people are still closing,
He was
right?
in that position, but yeah.
Yeah. So, and I tend to agree with your strategy a lot of times. Just price. I mean, if I'm listing a rental, sometimes it's good. You price it a little bit below market. You get more people. You get better people. You can be more selective. And to be honest with you, this is partly why we've seen rents decline in the GTA more quickly than prices because, with rents, landlords are way more sensitive because, they're basically bleeding cash every month. You know what I mean? An owner who wants to stick to their price and they live in their house can just wait out the market usually. The landlord isn't going to sit there 6 months with a vacant unit paying $3,500 a month or 3,000 in carrying costs. They're far more sensitive. They want to rent it sooner. And it's very different from how institutional landlords price. Institutional landlords will price high and gradually wait, and they could sit on that empty unit for a year because they have another 50 in the building or 100 in the building. So it's definitely one of the reasons why we've seen downward pressure on rents over the past little while. But yeah, it's super interesting dynamics. One thing actually I'll say on a tangent, I was speaking with an economist at a government kind of organization, and I do these quarterly calls with them. And one thing I kind of talked about, and it's kind of interesting, is that we're not typically when you see super sluggish sales in houses and condos, right? You typically see strong demand for rentals. Like it's not like people stop needing to move. You know what I mean? People who need to move, if they're not going to buy because they're anxious, they kind of decide to rent. And while, yes, we're seeing that to some extent for low-rise houses, for three-bedroom homes, we're not quite seeing it for all of the one-bedrooms. You know what I mean? It's still a very sluggish market. So it's super interesting, some of these differences. We're going to maybe bring Urmi on. I don't know if we have any questions to go over before we bring on David.
Yes, we do. The questions were a little slower. I thought maybe everyone went to the cottage, but some people are still here, at least for a few
I
seconds.
think we need to head to the cottage soon.
Oh, yes. Who can blame all Toronto area people after what we saw last night, the devastation? The sun is shining. Get the hell out of here. So, Gus, I don't know if that's all apathy you're feeling or maybe just the adrenaline glands, not just the politics, but the Leafs leading us all to take a break. In any case,
myself to sleep.
Oh, God. Why am I still a Leafs fan? I don't know. I had my pot fan jersey out. Oh, God. Anyway,
Old school.
yeah. Anyway, let us all move on to real estate, which is even slightly more hopeful right now. There's a big jump in listings, Dash6 says. So Gus also made the comment that the listings had come down a bit, or that they weren't piling up as quickly. So what would you say about the momentum, I guess, about active listings?
Momentum's a good word.
So active is different from new listings, right? Because active is a function of how many are coming on the market and how much are people buying, right? And like we said, when we looked at new listings, they're somewhat normal for houses, but very high for condos, right? So there's slightly different dynamics going on. But for both, active listings are quite high, right? you know, compared to historical norms.
Meaning
So
they're sitting on the market longer,
yeah.
but we're not. I don't know. Maybe. I mean, does it? Do you see? It feels like, anyways, just from my alerts that I'm sending clients from being on MLS. It's just I'm seeing a less of a flood of listings in the last couple of weeks than I was maybe 3-4 weeks ago. I know it's a very small sample, but that's what I'm getting in the areas that I'm looking at.
For freehold, we are approaching the end of the school year, which does, have some seasonality to it. I mean, it's only
Yes.
mid-May, so I wouldn't see the slowdown quite just yet. But maybe we're just running out of people who have to sell their houses because everyone tried to jump on the train early. I know for condos, we're not going to run it for a while, but
Yeah, I mean, I'm looking at I'm distracted because I'm looking at weekly stats. And the weekly stats, I mean, they're generally relatively steady. It's not, we haven't seen a big acceleration. So new listings aren't necessarily down, but they're not up very much. And usually they accelerate quite a bit as we move into the spring market. So yeah, not a ton. So maybe some people are hitting pause.
Yeah. All right. Thank you. So I'm just wondering which to go with next. How about this one from Carl, our frequent participant? Hi, Carl. Okay, I have cash and I want to buy a condo. Any suggestions?
Is that a serious question or a sarcastic one?
I don't know if we're being trolled.
it's funny. I had a client reach out to me just over the weekend. Works on Bay Street. He's now on the trading floor, and all of a sudden, out of nowhere, he's asking for power sales. Buy me all the power of sales, bank sales. I'll even ping ones where the remarks say motivated seller, and I told him as well. I'm like, let's look for ones owned by realtors.
There you go. That's a good
That's
one.
where you find a good deal, I think. Find all the condos owned by realtors, and they're it's slow, so they need to cut ties with something. Maybe it's a condo.
Find a condo that is tenanted with below market rents, or a property with below market rents.
That's a good one too.
If you want to move into, like,
if you don't mind dealing, like if you have some,
yeah,
you don't mind dealing with a little bit of risk and problem solving a bit. That's a good one.
100%. I mean, you should get a discount on the price. And
Yes.
I mean, just to unpack what I'm talking about, typically tenanted condos sell for less than vacant condos because there's always a risk that the tenant doesn't move out. And how much of a discount, of course, depends on what the rent is and who the seller is. But usually you can get them for quite a bit less because no one wants to buy them. Like oftentimes when we have clients who are like looking at buying a condo, the second they see it's tenanted, they're like, don't even look at, we don't want to look at it. Forget it. Next, only vacant properties or owner occupied. It's like not even on their radar. So, and it's tough because if you're a landlord and if you have a tenant who's cooperative will move out, you're kind of getting penalized because some people don't want to deal with it. But it's the challenging market we live in. So anyhow, I don't know if it was a serious questions, but I think I might do a video on buying a condo now because I feel like it's a tricky market to navigate. I don't have any easy answers for sure.
Well, what's the condo for is a big one.
Was that?
What's the condo for is a big one. Are you going to live in it?
Yeah.
Oh, yeah.
That's where my question was going. Is he looking for a 1-bedroom or like is he looking for a 2-3 bedroom he's going to live in? Because even the 2-3 bedrooms, they're doing okay. There's inventory, but they're doing okay. But if he's looking for a 1-bedroom investment, you can wheel and deal, I think, right now. I'm not saying it's a good time to do it. It really depends on everybody's specific position, how much cash you got, how risk averse you are. But definitely, I've been tracking 1-bedroom condos in the Young and Egg area or downtown that used to sell for 6+, and now they're begging for like 5.25, 550, and they're stale. So could you get one for low fives?
On that note, Curtis joined in and with an interesting question. Are there geographical differences in this condo slowdown? And they ask, are condos in North Toronto, North York, Vaughan area near the subway transit moving relatively quicker than condos not near transit? So are there mini trends within the slowdown?
I would think, I don't know off the top of my head because I haven't looked at the data, but I would think so. I would think stuff on transit is moving a little bit better. But I'd have to look. I don't know. Actually, I can't say for sure. I mean, like we could find that out. You can kind of do that analysis pretty quickly.
All right.
Quite so saturated, but it's saturated enough up at like the Young and Shepherd, Young and Finch kind of area. If that's what you're talking about.
Yeah.
Further still, even less so, but then you're getting out there a ways.
Yeah.
Okay, thank you. Let's just stay with one more segment question before we go to a FSBO question. So let's turn to the luxury market. The asker is called Tips. Tips wants a tip. What do you think about the luxury detached market in Toronto? It seems to be holding up okay this year.
That's
Agree?
actually a great question. I mean, I was
Disagree?
just talking about that with someone, and it's a very sharp observation. It is holding up relatively well. I mean,
John, when we
I
say
mean,
luxury, sorry to cut you off, but just to explain it, we're talking 4 mil plus here.
Yeah,
okay,
it's gonna go pretty high.
it depends on,
yeah.
yes, it depends
That
on
is
what we're
That's
another
who
talking
you
about.
asked, so I
Yes.
just, yeah.
Yeah. So,
good point.
I mean, I think the average person would probably, okay, I think the average
3
person
mil.
with a luxury is like over 2-3 million, I'd say. You know what I mean? Which I don't know is quite luxury, and you're right. I mean, true,
think-
real luxury now with
In
where
normal
prices are.
times, yes.
Not now. I think
I
it's
mean,
3
I feel
mil.
uncomfortable saying a $2 to $3 million home is upper middle class right now, but
Yeah.
It's crazy, but
so, but to answer the question, yeah, I mean, definitely, I'm finding that homes, even in the 4+ range, have been moving relatively well. You know, when stuff comes up and it's priced well, they sell quickly. I have clients looking in central Toronto, kind of, you know, 4 to 6 mil range, and yeah, things sell. And I think what's happening right now, you know, and it's very interesting because I think like in historical downturns, typically how the luxury kind of takes a hit, usually, like this is what historically happens. But it's not happening now. And I think, I don't know, I think the people in this segment have a ton of capital, have a ton of savings. They're not stretched. They're, you know, they're not buying based on their income. They have tons of money they're putting down. So they're not as impacted by everything that's going on. They just want to upsize. You know, they may not even need to sell their existing home. So they're not as constrained by the things that the average person deals with. Obviously, high rates impact everybody, and 4% is a bit high. But again, if you have a ton of money you're putting down, you don't have a huge mortgage, you know, that's not a big issue for you. So yeah, I think it is moving relatively well. Just surprising given how slow the market is.
All right. Well, thank you. I'm just going to add a comment here from Brooke, who maybe is joining the Mark Carney Club when they say, I just bought a house in Leslieville. I think Trump helped me on the price.
I mean, very possible, very possible. Trump is causing a lot of economic uncertainty and leading to a lot of people hitting pause, which is impacting some sellers a little bit. So,
All right. Actually, we
having
just
you in the closet there.
well, yes, let's go to
the
the let's go to the FSBO question, as our hardworking realtor now appears to be locked into the furnace room.
I'm like, what am I doing? Just sequester myself in the basement. No one's coming down here. What am I thinking?
All right.
And this is a good time to talk about FSBO. So what does your agent do? So I don't know how to pronounce this. Xmirlix asks, what do you think of FSBO in this environment? On a 500K condo, this listing or selling realtor will get 2.5%, so about 12,500 in this case. Could you be better off cutting your price by the 12,500 and move it quicker by yourself, assuming you have a minimum amount you need to get out of it? I assume that means getting out of the condo. Or do the realtors just hate FSBOs so much that you can't get any viewings? Also assuming that you offer the buyer agent their 2.5% still. And, you know, John, this is a question that comes up, you know, as the cycle shifts for sure.
It's a good question. So just to unpack everything.
Oh, and I didn't say what a FSBO was. For sale by owner, yes.
Yeah, so a FSBO is a for sale by owner. So you can actually list homes without a realtor on the MLS. There's companies that charge a flat fee, I don't know, $500 or $700. You'll list it on the MLS. Most, as the person said with the question, most people who do that will still give a commission to the buyer's agent. They'll give, you know, 2.5%. So, you know, technically the buyer's agent is still going to get paid. It's just that the seller isn't paying their own agent. And that's what they were referring to. Assume that that listing commission is 2.5%. You know, they'd be saving the 2.5% on the listing side, right? So I guess the first, I mean, there's a couple of things. I mean, I wouldn't necessarily assume every listing brokerage is going to charge you, I mean, 2.5% on the listing side. I mean, we charge, I mean, we can charge 2.5%. We typically do staging and stuff like that. We start at 1.5%. So not everyone is charging 2.5% is the first thing I'll say. You know, the second thing I'll say, I mean, there's a few things to keep in mind. Certainly, and the comment was like, is it harder to book showings? Can be more challenging. Like with a lot of like even getting information, I've noticed. I think it's not so much that agents ignore them. It's just when you have hundreds of listings, you want to make it easy. So a lot of times physical listings do not have a lot of photos. You've got to go through some other website and find the link to the virtual tour from that website to actually see the photos. And then, you know, on the realtor system to book showings, typically with a regular brokerage, you just click a link, schedule a showing. It's automated. It goes to your phone. It's very systematized. When you're booking 5 showings, it's very easy. With the for sale by owner, you got to find out the owner's contact info. It's just a little bit more challenging. So certainly that is a barrier, availability, all of that stuff. You know, and then again, marketing. I mean, I've seen people, you know, list their properties themselves. I mean, listen, objectively, they just don't look great. I mean, their photos were taken from a freaking iPhone. You know, they're taking photos that just don't present the property well. And I think one thing I'll say is I'm not even suggesting if you hire an agent, it's going to be better, because there are some agents who are terrible out there who will also take photos on their iPhone. So this is not an ad for all agents across the GTA. But, you know, if you're hiring someone good, they present it well, they market it better. You know, the idea is that it shows better, you negotiate better, and you get a better price, right? So personal preference, I'm not going to say one or the other. I think people's just going to do what works for them.
I think the biggest thing people overlook, and it's probably because maybe they haven't found a realtor that does this or haven't experienced it, is the person part of it, the communicating, the representation. You need to call every agent.
Yeah.
How'd the showing go? What happened? What was good? What was bad? Back and forth, get the feedback. You know, the negotiating part and the actual nitty gritty and a good agent will find you $5,000 or $10,000, which will make up for a lot of that commission on a listing like that. Whereas if you have an agent offering you, a buyer agent offering and negotiating with the seller, I'm sorry, but most often that agent will have a bit more of negotiating, you know, experience than that seller possibly, and might get the advantage on them for $5,000 or so.
And you're right. And I think I may have talked about this on another video, but like even in this market, when the market's slow, like we've had multiple listings this year that we didn't price for a bidding war, that were priced a bit high, but we still got multiple offers, right? And how do you get multiple offers if you're not set up for multiple offers? It's because when we got the first offer, or when we heard that the first offer is coming in, we pick up the phone and chase every agent down to try to bring in another offer. Like, yeah, you can just send them an email like, we got an offer, let me know if you're interested. But when you call people, you can listen to them and hear what their thoughts are. And a lot of times some agents will say, well, we don't want to compete. We're only willing to go to X price. Well, when you're on the phone, you can say, come in at X price. Maybe you're going to get a chance, and give them some hope and bring them in. You know, we don't know if they're going to stand a chance, but the point is you're trying to lure them in, because the reality is, even if they're not competitive, if the other offer ends up being competitive, having that second one's going to help that higher offer be a little bit more aggressive and give you better terms. So yeah, 100%. Like these are the nuances of negotiating that are kind of harder to do when you're representing yourself, I find, and some of the things that, you know, a good broker should be doing. So now I'm going to actually leave it on all the questions. I just realized it's 12:45 and we've chatted a lot, and Mr. Larock is waiting, and we need to chat about macro and mortgage trends. So guys, Gus, Davin, thank you. And Urmi, thank you for the questions.
Thank you.
And David, we've left you in limbo for a very long time today. We went on tangents with all of our questions.
Well, lots of good topics. I enjoyed hearing the insights, and
Yes.
it was nice to see Davin walking through with the live tour there while the questions were answered.
Yes. So, because we're kind of pressed for time, why don't we kick off with you giving us a quick update on what is going on macro-wise? You wrote a little, you wrote a post last week about what happened with the U.S. Fed, what's going on with their policies, employment, inflation, how it's going to impact what they're doing, and what the outlook is for Canada. So maybe if you can kind of just give us a broader look at what is going on in the economies in the U.S. and Canada and how that's all playing out.
Sure. Well, of course, we pay attention to what the Fed does because we trade so much with the U.S. and because Fed policy impacts the relative to Bank of Canada policy impacts the exchange rate, and also our bond yields move quite in tight correlation with U.S. bond yields. So the Bank of Canada has cut by 2.25%. The Fed's only cut by 0.5% so far. And U.S. President Trump wants the Fed to cut. He wants lower interest rates. He's a real estate guy. And he also doesn't like the fact that the U.S. dollar is still quite strong. Because while that makes imports cheaper, it makes U.S. exports more expensive. And he's all obsessed with the trade deficit. We can argue about whether or not that's actually a problem, but it is in his eyes. Anyway, the Fed isn't cutting rates. They've said employment is strong, inflation is under control. U.S. inflation, we learned this week, dropped to 2.3% on an annualized basis last month. It was at 2.4%. So the Fed has said there's really no urgency for us to cut, and we're worried that tariffs will raise prices and be inflationary, which any economist worth their salt agrees with. Interestingly, because of what Trump's doing, though, it's undermined a lot of faith in the US dollar. Normally, when the Bank of Canada has cut by so much and the gap between the Fed funds rate and the Bank of Canada's policy rate is as wide as it is, it's right now about 1.5%, you'd see a much weaker loonie. But what's happening is there's concern about whether or not US policy can really be trusted. And that has meant that the US dollar has weakened more than it otherwise would or should in uncertain times. Normally, the US dollar is the world's reserve currency. And when there's any kind of instability, even instability coming from the US, it causes demand for safe haven assets to go up. And the US dollar and US treasuries are the ultimate safe haven assets. But Trump has managed to undermine a lot of that faith in both. And that has meant that the dollar has not appreciated like it normally would. And it's meant that treasury yields have actually gone up, both because investors see higher inflation risks and also because people are selling US treasuries. And when bonds are sold, the yields go up. Now, we have been pulled along by that. That has Canadian implications. When US treasury yields rise, they typically pull government of Canada bond yields higher. And right now, even though we're expecting weakness in the Canadian economy, so far yields have risen and fixed mortgage rates, which are priced on government of Canada bond yields, have actually gone up of late. So how does this all play out? Well, interestingly, the Bank of Canada has more room to cut and is less worried about the exchange rate causing negative implications if it does cut. And we had a pretty weak employment report. This past week we got the headline said we added 7,000 jobs, but that's because, quite frankly, we added 30,000 employees because of the federal election, and if we hadn't accounted them, it would have been a month of job losses. More importantly, we lost a ton of manufacturing jobs. We lost net 30,000 jobs overall, but that was nationwide. We lost 50,000 jobs in Ontario, and a lot of those are in the automotive sector, which tend to be higher paying. And with manufacturing jobs lead to an average of 2.7 other jobs in the broader economy. So basically, when they're manufacturing jobs, there are other service jobs that need to be created to support those manufacturing jobs. So when you lose manufacturing jobs, not only do you lose higher paying employment, which tends to overlap with home ownership, but you also lose downstream jobs that are tied to those manufacturing jobs. So economically, there are emerging signs of weakness to the surprise of no one. And that's really where we are. In the US, the data haven't really started to weaken too much. So far, it's just sentiment. Consumers and businesses are very concerned about their prospects looking forward. Generally, that's called soft data. You first see weakness in the soft data, it translates into the hard data. The US employment report that came out most recently was strong. It beat expectations, but the cutoff for when the data was captured for that report was right as Trump announced the Liberation Day tariffs. So we are now at a point where everybody expects the data to weaken, but so far it hasn't, at least in the US, started to weaken too much. So as we head into the summer, we expect weaker US data. And the bond yield battle in the US will be people want to sell US Treasuries because they're worried about President Trump and how unpredictable he is. But US economic growth is weakening. If US inflation continues to cool, that'll put downward pressure on bond yields. So not quite sure how that's going to play out. But in Canada, I expect the Bank of Canada to cut at its next meeting. The bond market is pricing in another 0.5% worth of BOC cuts. That will drop variable rates by the same amount. So if the BOC cuts by another 0.5%, variable rates will also drop by a further 0.5% over the coming months. I think they'll go lower. I think by the time we're done, we'll get at least another 0.75% in cuts from the Bank of Canada. And again, that'll translate directly into variable mortgage rates. Fixed mortgage rates are priced on Government of Canada bond yields, which certainly pay attention to what the bank is doing, but they've already priced in that 50 basis points worth of cuts that are expected. So if the BOC does what's expected, bond yields don't have much room to go lower in the near term. And because US Treasuries are rising, that's actually putting upward pressure on bond yields, which is translating into some fixed rate mortgage increases. So in terms of where we're at, everybody's waiting for the other shoe to drop. We know these tariffs are going to be bad for the economy. Interestingly, I know Trump announced a deal with China where some of those tariffs were going to be backed off. The S&P 500 is now higher than it was before Trump announced his tariffs. And what's strange to me is if I told you that the average US tariff rate would go from 2.5% to 13%, what do you think that would do for the S&P 500? You'd probably say it would go down because that's a quadrupling of the tariff rate. But because Trump's tariffs got ridiculously high and now they've been reduced, the market is getting ahead of itself and it's actually up. So basically the impact of a fourfold increase in the average US tariff rate has coincided with the S&P 500 going up, not down. Again, this stuff will all sort itself out in the coming months. Businesses will issue their profit reports and their quarterly statements. The economic data will reflect what's happening in the economy. And businesses and consumers in the US are very concerned, as are Canadian businesses and consumers. So I think we're a bit, unfortunately, John, I think we've got this Wile E. Coyote moment where the coyote's gone over the cliff and his legs are still pumping like crazy. And, you know, in the cartoon for people of a certain age, he looks down, he realizes he's not standing on anything anymore, and down he goes. I think, unfortunately, we are going to see weakness in the US and Canada as we head into the summer. I think that's going to lower rates. But ultimately, as per the conversation you guys had with Gus and Davin before I jumped on, the real estate market could use all the help it can get right now, and how that's going to translate lower rates into the real estate market. As you and I have talked about before, this isn't COVID. We don't have huge pandemic savings. People are really being impacted now. This isn't the US financial crisis of 2008 when rates went down, but our housing market stayed strong and our economy was largely unaffected. This is the real deal, and we are seeing economic slowness, and ultimately lower rates will be a silver lining for what otherwise looks like, unfortunately, a sluggish market as we head into the summer.
Interesting. Now, when you talk about the Bank of Canada cutting, are you thinking that they're doing so to get ahead of the expected increase in inflation due to the tariffs? Because, I mean, I think aside from the short-term dip we're probably going to get soon because of the carbon tax cut, I think the outlook, we're probably going to see inflation tick up due to the tariffs and potentially due to the kind of slowdown in the economy. Is that what you're thinking? They're basically trying to get ahead of those trends?
Well, yes and no. I think basically the bank, if inflation is too high, the bank has to address that, and that is its only mandate, is to keep prices stable. They're forecasting that inflation is going to come in at about 1.5% in our next inflation report, which is due out next week. If we get that, certainly 2% is their target. Obviously, the carbon tax is going to be part of the reason why it comes in lower. But I think the bank right now is not overly concerned about runaway inflation. When COVID hit, not all the companies were affected by higher costs. A bunch of other companies said, "Hey, everyone's worried about higher costs. We can increase prices opportunistically, even though we don't need to, and just make more money." With the economy slowing, with consumers becoming more cautious, I think businesses are less likely to try that this time around. Interestingly, Prime Minister Carney backed off some of the tariff countermeasures after meeting with Trump. Canadians, by the way, are, by not buying U.S. products and not traveling to the U.S., we are registering our discontent with U.S. President Trump in other ways that are impacting the U.S. economy negatively without countermeasures, because counter tariffs that we enact make the stuff we buy more expensive. They create Canadian inflation. So ultimately, John, I think the Bank of Canada has flexibility to cut if it wants to, because inflation doesn't demand that they keep monetary policy tighter. And I think the Bank of Canada is concerned about growth. And if inflation doesn't prevent them from doing it, I think they do want to keep cutting, both as insurance for economic weakness to come, and because at some point the economy is going to need some stimulus if we get that economic weakness. And at 2.75%, which is where the BOC's policy rate is right now, that's the middle of what's considered its neutral rate range. That's when the Bank of Canada's policy rate isn't hitting the brakes. It isn't causing demand. It isn't reducing demand in the economy to slow inflation like it was when it was up around 5% and inflation was up around 8 or 9%. Bank's not hitting the brake anymore when its policy rate is at 2.75. But it's not stimulating demand and helping the economy until that policy rate hits 2%. And again, right now it's at 2.75. So if the bank thinks that at some point in the future, it needs to stimulate demand in the economy to help for the economic weakness to come, it's got to get down to 2%. And it doesn't want to go from 2.75 to 2% in one fell swoop. It wants to incrementally work its way down, because the Bank has policy rate is pervasive throughout the economy. It's a powerful instrument. They want to toggle it slowly. So I think if 2% is their end game, and again, 5 rate cut cycles in the past 25 years, they've always gone to 2% or less. So that would not be new territory for them. If that's where they're headed, then we need to see more quarter point cuts to come in over the summer, and I think we'll get them.
That's helpful. And just for me to clarify a brain freeze so no one else is confused, I think I had mentioned cutting rates to get ahead of potential inflation. Obviously, the bank doesn't really cut rates if inflation is increasing. I woke up at 4 o'clock in the morning today, so my brain is not working very well, and
they're cutting to get ahead of economic weakness
of the slowdown. Exactly, 100%.
Yeah, I agree.
We'll bring on Urmi. I don't know if we have any questions.
Well, I think actually you've answered it very well, Dave. So the question from Ray, is there chatter for emergency cut by the BOC? I think you've explained all the conditions in which they might feel free to act if they feel it's necessary. And I
don't think we'll get an emergency cut, Urmi. I think they'd much rather spin the dial slowly, and they've got some license to do that. This isn't COVID.
Awesome.
That's I found your points there very interesting about COVID. No, I think that's it, John. We're hitting on the hour. You had a rough night. Lots of us did, but for other reasons, maybe it's time to head for the cottage.
The Leaf fans need a break. They need to recover before the next game. So we will wrap it up there. I hope everyone enjoys the long weekend, and we will see everybody next month. Thank you, everybody.
Yeah, sun's out. Enjoy, everyone. Thanks for joining us.